Equities have gotten a little bit rocky here. We've been testing some key levels of support. I thought we'd also take a look at some of the dynamics that are in place that are affecting, rates and what's really moving these currencies and FX markets. I think these days, I think it has a lot to do with interest rate differentials. But I thought before we got into that, we would just take a look at some of the economic data on the schedule. And right now we're looking for JOLTS. This is going to be for the month of January. So at this point, this is almost, 2 months old. This would have aligned with the January job report, not the February job report. So we're a little bit behind here. We're looking for 7.75 million, and that's basically in line with where we were last month. Core CPI is expected to rise by 0.3%, although that's expected to come down a little bit from 0.4%. Obviously, in core, you want to pay attention to things like airline fares and hospital rates and things like that, because those are the things that go into PCE. And then, of course, for year over year, we're looking for core to come down to 3.2 from 3.3. CPI year over year, we're looking for 0.3% down from 0.5. And we're looking for the year over year rate to drop to 2.9 from 3%. At least when you're looking at swap pricing, it's around 3% as well. These are the May contracts that trade for February. They're trading right around the 290 level too, and they've been there now for some time, so I'm not really expecting anything that much different based off of that pricing. PPI, we're looking for year over year to come down to 3.3 from 3.5. Final demand expected to slow to 0.3 from 0.4. Ex-food and energy, 3.6% in line with last month. Month over month, we're looking for 0.3% in line with last month as well. And so I don't think this week the economic data is going to play too much of a role in what's happening in the equity market unless we get some sort of major surprise. The bigger question, obviously, will also be what's going on overseas, because we know that Japan has been seeing their rates go up pretty dramatically. And so you can see we're going to be getting some overtime pay, and we're going to be getting some GDP numbers. And so these are going to be important to take a look at. And then in Germany, you're going to be getting the final CPI reading, and you'll also be getting some industrial production numbers. So these are important numbers just because of everything that's going on in the rates market. And at least when we start off with the equity market, we'll just take a look at some support levels. 5670, I think, continues to be a very important level of support for this market, just because we bounced off of there on Friday, and this has been an important level just going back now, really since the highs in July. So you're going to want to see this level really kind of hold. If it breaks, and not just breaking intraday, but really breaking and closing below that level and then getting follow through the next day, I think it sends an important signal. It's also where the 200-day moving average is. I'm not really a big fan of using moving averages as any sort of indication, just because they can tend to fake you out on a number of different occasions. So while they're nice, I don't really put much stock in them. And really, when we look at the S&P from this standpoint as well, I still think this 5,900 region probably offers a pretty meaningful level of resistance. But more importantly is what we want to look at is really what's happening in the FX markets. And what we saw last week in the euro was pretty amazing when you could see that the size of the move. I mean, anyone that follows FX knows that these are really big moves. Although I would say that right now the euro is probably looking a little bit overextended. I like to use two different indicators usually to verify an overbought condition. And so what I'll do is I'll use the upper Bollinger Band when we breach the upper Bollinger Band in conjunction with an RSI moving above 70. That would suggest that we're probably overbought. It doesn't necessarily mean you have to pull back, but what I would expect is some sort of consolidation and a move back into the into the Bollinger Bands, and things have them settle out. What's really interesting about the euro too is how we basically saw the euro get down to the 61.8% retracement level around this 102 area if you measure it from this low to this high. And this was really the key level that got tested a bunch of times. And now you can really make a case that maybe the euro has put in some sort of meaningful longer-term bottom here. You can see a nice sort of bottoming process in the RSI with the nice breakout to the upside. Certainly looks like that could be a potential reason. And another reason is really because of what's happening in the interest rate complex, with the German 10-year really moving up pretty sharply, and also kind of getting back towards the upper end of this range, given what's happening over there with defense spending and infrastructure spending. You saw the same thing happen in France with its 10-year rate moving in sympathy, and you saw the same thing with Italian 10-year rates moving up pretty sharply, although they still have much further to climb based off of where French and German rates are paying. And you can see Spanish bonds also moved up pretty sharply. So overall, you're just seeing interest rates across Europe really move up. If we're going to see the really rates in Europe continue to rise as they start spending more on defense and infrastructure and trying to really get growth going again, as the U.S. kind of shifts its political outlook, you would expect the euro really to continue to move higher. And one reason also, if you take a look at a German 10-year real yield and you subtract that from a U.S. 10-year real yield, what you get is basically what the euro has been doing. And it really identifies and shows you how interest rate differentials, especially when you're looking at it from a real rate perspective, basically tips. German rates have been sort of catching up to where 10-year real yields are here in the U.S. And as that spread contracts and moves back towards zero, that's really going to be what pushes euro higher if that continues to take place. And it's really the same thing when you look at what's happening. The Japanese yen has a similar format. Again, what you just do here is you take a U.S. 10-year real yield and you subtract it from a Japanese 10-year real yield, which, by the way, are still negative in Japan. And then you can clearly see that the movements in the yen are really being driven by interest rates and differentials. And so when we look also at just the nominal rate in Japan, that's also been moving higher now because Japan obviously has has seen inflation really ramp back up. You've seen now that the BOJ is committed to probably raising rates a couple more times. It sounds like their view of the neutral rate is somewhere around 1%. And you can clearly see that, the Japanese 10-year has moved up dramatically over the last couple of weeks. In fact, it was just at the end of the year we were trading around 1%, and now we're trading up around 1.51%. And so what this has also done is basically collapse the spread between U.S. 10 nominal 10s and Japanese 10s. And why this is important is, again, what we're looking at here is basically a situation where this trade, the Japanese yen, could really, again, start strengthening materially. Now, this is something we had touched on over the summer. And again, for whatever reason, we managed to survive that test. But what you can see is how important this level is right around this 2.8% differential. And if this spread were to really start breaking down in a meaningful way, whether it because 10-year rates here in the U.S. start really going down or because 10-year rates in Japan really start going up, that would really start to lead to the Japanese yen continuing to strengthen in a much more material way. In fact, when we tested this last, it was August and September, and that was when we were seeing, obviously, that mini Japanese carry trade unwind. And, again, you can see here where we are. I mean, the last time we were at these levels, the yen was closer to 140 than it is now, where it's around 148. So just based on where the differential is now, you can make an argument and say, maybe that the Japanese yen should be around 140, a little bit stronger versus the dollar. And if you were to start really seeing this breaking down, I mean, what's to say that, the yen couldn't be trading at 130, and suddenly that really may start influencing, flows. So you're talking about a scenario where the yen can really continue to strengthen materially versus the dollar, and the euro can continue to strengthen versus the dollar based on these differentials. And the other piece is you're also seeing this happening really in the British pound. You've seen the British pound begin to move higher. And again, this isn't all necessarily because of, it's not what it basically is telling us is that the market's really not responding necessarily to the growth scare aspect of it. What you're seeing really happening in the market is that the market is responding to the policies that are being put in place here in the U.S. and how that's reverberating throughout the world. And, clearly, if Germany doesn't go ahead with this spending plan, rates in Germany don't go up as much as they've gone up. The euro probably doesn't strengthen as much as it strengthens. But because of the policies that are being put in place, it's causing this reverberation through the world where the world is responding. And it's responding by redirecting its policies. And this is really what's driving the dislocation in the market, so to speak. And I think that this can probably continue to happen as long as we continue to see, U.S. policy sort of pointing in a way that forces the rest of the world to kind of start spending more on defense or whatever it is they're trying to, that they're not going to be getting from the U.S. in the future. And that really does create this risk that you start seeing more outflows from U.S. equities back into and repatriating back to their country of origin. Anyway, I hope you found this helpful. Please remember to subscribe to this channel, like this video, share it with your friends. Today is Saturday, and we'll be back midweek. Bye.